Matt, what do tennis and investing have in common?
Actually, quite a bit.
Welcome to another quarterly commentary. My name is Lorenzo Petrozzani. I'm one of the portfolio managers at Westmount Wealth, and I'm joined by Matthew Evans. Today, instead of giving you the usual format where we discuss performance of different indices over the quarter, we're going to take it back to the fundamentals and reframe the discussion in terms of how we should be thinking about as investors during difficult times in the market. And we're going to use tennis as an analogy. So let's get right into it.
Well, it was definitely a challenging quarter for investors. And whenever we go through a difficult time, it's important to get back to investing basics.
So let's talk about investing and winning as investors long-term and relate it to the game of tennis. And what lessons can we take from looking at tennis? Well, there's not one fail-safe way, but in general, the player who has the ability to keep rallying, keep getting the ball over the net, will give themselves the best chance of having the opponent make unforced errors. So the longer you keep the ball in play, the better it's going to be. We think about it and relate it to investing with four simple concepts here. Winning in tennis is about controlling risk. And when we think about controlling risk, it's about minimizing the big swings. It's about consistency, trying to continue hitting the ball over the net, shot after shot. It's about stamina. You're not going to win a game unless you're in shape. And we relate that to investing in terms of having a long-term view of things. And it's also about strategy. You should come into any situation with a game plan, but be able to be flexible enough to adapt it if things are changing or not going your way. And we think about that from an investing perspective as, knowing when to be strategic and also when to introduce a bit of a tactical element to your investing strategy. So Matt, why don't you walk us through the controlling risk side of things?
When we're talking about controlling risk, whether in tennis or investing, we're talking about avoiding those big swings, because when you swing big, you can miss big. So to us, that means not making any large bets on a single security, an industry, a theme. It means never trying to time the market, and further to that point, never getting yourself out of the game or out of the market completely. A perfect example is looking at the data over the last 9 years. Whether you're looking at a sector, an industry, or an index, you hardly ever get consistency in returns. Meaning if you look at oil as an investment, in 2018, it was the worst performing area, while in 2019, it became the second best investment idea. So really what we're saying here is spread the risk wide, take a diversified approach, and never try to make those big bets.
When we see difficult time, like we've been seeing in the markets of late, a very natural question that we get from investors is whether or not it's a good time to invest. Obviously, all of us want to be self-maximizing and invest at the best possible time. The reality is we can never know what's going on in the markets. And so even if we did have full control and perfect ability to time the markets, would it even make that much of a difference? And National Bank did a very interesting hypothetical analysis recently, and they took a look at an investor and they said, what about if somebody started investing in 1990 and they invested $1,000 a year? In the first scenario, shown by the blue line, somebody invested on the worst day or the lowest price of the stock market on any given year, every year from 1990 until this year. And that would have yielded a return of 8.4% a year.
So in other words, they're the perfect market time.
They're the perfect market time. And the hypothetical, every year for 23 years, for 33 years, they nailed the best time to invest, the best day to invest on that year. Now let's take a look at the flip side. Somebody invests $1,000 at the worst day of the year, every year for 33 years. So they pick the highest point of the TSX that year. That person would have a compound rate of return of 7.4%. Still pretty good relative to Mr. Perfect Timer. Now what about if somebody just saved $83 a month, every month for that same period of time? That person would have a compound rate of return of 8% a year. The bottom line is, perfect timing is impossible. If you just simply do dollar cost averaging, it's going to get you pretty close to the perfect scenario anyhow. So perhaps the stress that people put on themselves around market timing is really not that material. And furthermore, the worst thing you can do is take yourself out of the game. If you take a look at the chart on the screen right now, you'll see that there's a lot of noise, but we want you to focus on two things. One is the red boxes. What you'll see there is those are years in which people are getting out of the equity markets. And what you'll notice looking at the black line is that you see, every 5 to 10 years, big market correction, market bottoms out. And then for 1 to 4 years after the market has bottomed out, people are still getting out of the equity markets while the equity markets is rebounding, effectively doing the wrong thing at the wrong time. Ultimately, we know that over time, the equity markets in the developed world have continued to grow. And if you want a chance at winning in the game, you have to stay in the game to win. You don't want to be making the wrong decision at the wrong time. Big picture, bring it back to tennis. One of the ways in which we win is to control risk. That's about limiting the big swings you make. It's about not trying to time the markets, and it's also about staying invested and keeping yourself in the game.
Another lesson we'll take from tennis is consistency. It's about hitting the ball back over the net. For us at Westmount, that means diversification. That allows us to continuously get a smooth return pattern for our clients. Now, a traditional portfolio is typically diversified between stocks and bonds, and typically they work inversely during different economic times as a way to diversify a portfolio. What we do is we take that one step further and add in alternative or private asset classes to enhance that diversification. So when we look at how that works in the context of a regular portfolio, what we're trying to do is decrease the volatility and increase the potential return set of that portfolio. That allows us to remain consistent and get the ball back over the net. So not only do we diversify across asset classes, we diversify within. So when we're specifically looking at our equity allocations in our model portfolios, we have exposure to over 8,000 companies in developed markets. And we do this using a low-cost indexing approach. The research has shown, when you look at the SPIVA reports, which are produced semi-annually, that active managers do not have that persistency of outperformance relative to their benchmark, or in this case, an index. And therefore, to increase the probability of return sets for our clients, we instead utilize low-cost indexing when we're talking about efficient developed market economies. So from a consistency standpoint, that allows us to, again, continue to get the ball over the net.
So stamina in tennis means having the fitness level to be able to last 2 to 3 hours and win a game. On the investing side of things, it's about being able to maintain a long-term discipline. Satish Rai, who is a well-known investment figure in Canada, he is the former Chief Investment Officers of one of the largest pension plans in Canada, was recently quoted as saying the biggest mistake investors generally make is confusing time horizon and return. The shorter the time horizon, the worse the returns by far. You have to go into it thinking it's a long-term horizon. So let's talk about the last of the 4 concepts, which is strategy. It's important to enter any tennis match with a plan of action, a strategy of how you're going to execute, but also to be able to be flexible to make changes as needed. And much like you hire a coach as a pro to help build the strategy and help you modify the game plan during the match, you hire us as investment advisors to do the same. So let's talk a little bit about some of the tactical changes that we made to our models this year.
In an environment where we may have higher rates for a longer period of time, we've made a few adjustments to our strategy. This includes reducing our private real estate exposure and increasing our private infrastructure exposure. Private real estate may be challenged in an environment where the cost of capital is higher, while private infrastructure has the ability to pass through higher inflationary costs through inflation-adjusted contracts. On the other side, we've reduced down our private mortgage exposure and we've increased our private debt exposure. Private mortgages may be under stress as that end borrower is dealing with a higher cost of capital, which could lead to higher loan losses. Conversely, if we look at private credit, where you're underwriting a deal today, you're going to have a stronger covenant package, and you're going to be underwriting that deal knowing that you may be going into a period of economic weakness. On top of that, we've got a nice, healthy spread above SOFR, and you're actually compensated for the risk that you're taking in that area. Finally, we've added music royalties to our investment mix as a way to diversify clients outside of economic events, because traditionally, music is uncorrelated, or the consumption of music is uncorrelated to the economy.
Thanks, Matt. So in summary, investing is a lot like the game of tennis. If we want to give ourselves the best probability of success long-term, it's important to avoid making those big swings, to try and keep consistently hitting the ball over net, have that stamina, take that long-term approach to investing, and ultimately have a game plan, but be tactical and nimble where needed. If you have any questions, as always, feel free to lob us a question. I went there. See you next quarter.